price pressure, policy fear, and a precious metal pullback that looks like a wound on the surface. But underneath, it may be one of the most important signals the market has handed investors all year. A signal so uncomfortable, so against the grain, that most people will do the exact opposite of what it's telling them. Gold is falling, fear is climbing, and once again the market is confusing short-term stress for long-term weakness. Here is the version of the story you're being sold, and it sounds airtight. Inflation just came in hot. May CPI hit 4.2% year over year, the fastest pace since 2023. Rate hike fears are back. The dollar is firming, and gold has dropped close to 12% in just 9 trading days, sliding from its late May high near $4,627 down toward $4,200. Higher inflation, higher rates, lower gold. Clean, logical, case closed. But that clean story is exactly where the danger begins, because this is not the first time we've watched this pattern unfold, and it almost never ends the way the headlines promise. My name is May, and this is What Changes, the channel where we track the real shifts in the global financial system before the headlines catch up. And today I want to show you why this sell-off might be a buy signal, not a comfortable one, not a safe one, a perilous one, the kind that scares almost everyone out right before the move they were waiting for. Stay with me, because by the end you'll understand both why this could be an opportunity and why it's so dangerous to misread. Let's start with the pattern, because patterns are where the truth hides. Every time markets brace for aggressive rate hikes, gold sells off first. We saw it before. And in cycle after cycle, that fear-driven sell-off didn't mark the end of gold's run. It marked the pause right before the next leg higher. Why does this keep happening? Because raising rates into a heavily indebted system does not actually cure the problem. It pressures the system until something cracks. And when something cracks, the response is always the same. Now let me connect the dots, because this is where it gets serious. The United States is carrying a national debt approaching $39 trillion. That is larger than the entire American economy. And the cost of simply servicing that debt, the interest, has now crossed roughly $1 trillion a year, on track to more than double over the next decade. Sit with that. The government is on a path where interest payments alone could become one of its single largest expenses, crowding out everything else. That creates a contradiction the Federal Reserve cannot escape. On one side, it needs higher rates to fight inflation. On the other side, every notch higher makes that mountain of debt more expensive and more fragile. The system simply cannot tolerate high rates indefinitely. It is structurally brittle, and that brittleness is exactly what gold is quietly pricing in, just not in the way the crowd expects. Because here's the key. In the short term, markets react to policy expectations. In the long term, they react to policy consequences. And the consequence of pushing rates too high in a debt-saturated world is always the same word: something breaks. So what you're really watching is a tug-of-war between two forces. On one side, short-term tightening, hot inflation, rate hike fears, a strong dollar, all dragging gold down right now. On the other side, the structural reality, record debt, persistent inflation, a fragile system, all quietly building pressure underneath. Today, the short-term side is winning. But winning the week is not the same as winning the cycle. And here is the signal that almost nobody on the retail side is watching closely enough. While individual investors are reacting to red candles on a chart, the most powerful institutions on the planet are doing the opposite. Central banks bought a net 244 tons of gold in just the first quarter of this year, the fastest quarterly pace in over a year, more than $37 billion spent. They're accumulating at a steady clip of roughly 60 tons a month, and they're buying above $4,000 an ounce without flinching. China's central bank just logged its 19th straight month of purchases. These are not traders chasing momentum. They are reserve managers repositioning for the next decade. They aren't waiting for the perfect dip. They're buying into weakness, on purpose. And the big Wall Street desks are not backing off either. Goldman Sachs has held its year-end target of $5,400 an ounce. And here's the part that matters. when Goldman recently stripped all remaining 2026 rate cuts out of its forecast, it left that gold target completely intact. Think about what that means. Even in a world of higher for longer rates, the gold call didn't move. JPMorgan is pointing even higher, towards $6,300. These are some of the most influential institutions in global finance, and they are not selling into this fear. They are preparing for what comes after it. Now, this is the part I have to be honest with you about, because the title of this video says Perilous, and I mean it. A buy signal is not a guarantee. This dip is uncomfortable for a reason, and it could get more uncomfortable before it turns. These corrections can run deeper and last longer than anyone expects. Volatility can stay brutal. Gold can grind lower, chop sideways, and shake out impatient buyers before it does anything exciting. Anyone who tells you they know the exact bottom is selling you something. The signal here is structural, not a timing call. So the peril isn't that the thesis is wrong, it's that the path is rough, and most people can't sit through the discomfort long enough to be there when it pays. That's what makes these moments so deceptive. The sell-off feels like the end of the story. It looks like weakness. It looks like the rally is over, and you got caught. But historically, this is exactly the kind of environment where the foundation for the next move gets built, not when everyone's confident and the headlines are glowing, but right now, when sentiment is sour and the crowd is nervous. So here's where we actually stand. Gold has corrected hard. The dollar is strong. Yields are up. The narrative has turned negative. That's the surface. But beneath it, the structural pressures are intensifying, not easing. The debt is unsustainable. Inflation is sticky and arguably strengthening. Central banks are quietly accumulating, and the Fed is being walked toward an impossible choice, because eventually that choice has to be made. The moment controlling inflation and protecting financial stability point in opposite directions, and in a system this leveraged, they will. History tells us which one wins. Every single time, when something important is on the verge of breaking, policymakers choose stability. They cut. They add liquidity. They tolerate inflation running hotter than they'd ever admit out loud. And when that pivot comes, gold does not drift higher politely. It moves suddenly, and it moves hard. So the real question is not why gold is falling today. The real question is what that fall is setting up for tomorrow. Because the sequence rhymes every cycle. Fear of rate hikes pushes gold down, policy pressure builds, something cracks, the Fed reverses, and gold runs to new highs. We are deep inside that sequence again right now. The dip in front of you may feel painful. It may genuinely look like weakness. But that is precisely where opportunity tends to hide, wrapped in exactly enough fear to keep most people from touching it. That's the peril. And that's the signal. Now I want to hear from you. Do you think this sell-off is the beginning of a bigger decline in gold, or the setup for the next major breakout? Tell me in the comments. I read every single one, and your perspective shapes the videos I make next. If you want deeper analysis like this, and you want to see these shifts before the headlines catch up, join the What Changes email list. The link is right below this video. And if this research is valuable to you, you can support the channel by buying me a coffee. Every contribution keeps the work going. This is May, and this is What Changes. Stay sharp, stay informed, and keep watching What Changes.